Investors, it's one of my favorite times of the year. What's that? Baseball, preseason, spring training. I know last week's was a bit of a downer in the video, bringing bad news percolating behind the scenes in the economy that many in the media won't tell you about. This week, it's back to good news. Yes, Virginia, there is a Santa Claus, and he's still riding his sleigh in a bull market for equities. Let's just retitle the 1976 sports comedy for this week's title and call it The Bad News for Bears.
There is no limit to what some men will do for money.
We looked at the data behind the data last week to show you that the economy is losing momentum very quickly. However, slowing doesn't mean shrinking. This week, there are a few quick hits on a continued bullish setup for stocks for 2025. Let's start with the obvious. As of this writing, the S&P 500 was sitting at close to a daily all-time high. It's sitting at 6114 within a few points made back on my birthday, December 6th last year. There are a few hedge funds and trading isms that come close to always being true rules for the stock markets in my book. Let's start with the biggies. First, price is truth. May not believe that the price is the right price. Still, the markets are bigger than any one opinion, and collectively, they think we deserve to be at or near new all-time highs in the markets. Here's a chart of the daily S&P 500 over the last few years since the pivot lows in October 2022. I've drawn an upward sloping channel around the bands we've traded in since then and circled a few key lows like the late October 2023 low when the hysteria was high around recessions or duplicate crashes like 1987, or many in the EWT, that's Elliott wave theorists, panicked and got emotional and biased and decided to stop following charts and start trying to call generational tops. I circled the midsummer swoon caused by the yen carry trade blowups last year, and regardless of those short-term trauma, news events, election outcome, or going-ons, here we sit within a few points of an all-time high in the S&P 500. Even more interesting, here's the daily chart for the S&P 500 over the last year. Upward sloping overall, great returns in 2024 that many missed it, being bearish or for whatever reason. And here we sit. I've even marked the periods last year where the markets traded sideways for a period of time before resuming their upward path. Try to recall all the events that happened in 2024 along the way and tell me how, if we're not in a bull market still, the S&P 500 went sideways for 45 to 46 days exactly twice before breaking out to new all-time highs and trending higher for at least 2 months. And as of this writing, February 16th, Sunday, there have been exactly, 46 trading days since the last all-time high close on December 6th, and still, I hear most of the media is bearish. Folks, this is what a bull market looks like. A picture is worth a million words in dollars. Steve Cohen's first rule of trading is never short a new high or buy a new low. Be my guest if you want to. Short here new all-time highs, take a shot, try to be a hero and try to make a name for yourself, but the odds in the history say, be long and stay long here. According to 314 research, only 13% of times since 1950 have these setups led to corrections. Investors, price is truth, and the price says times are good. The second positive things for stocks, earnings have been overall good, even with higher interest rates and a higher dollar in the fourth quarter of 2024, dampening some of the earnings leverage that many large S&P 500 companies have. According to Fidelity, 77% of companies have beaten estimates by an average of 655 basis points. What started earnings season as 8% growth looks to have exited at 13% growth. And that's with both higher borrowing rates and a higher dollar in the fourth quarter. The good news for the second half of 2025 is most companies are already cutting forward growth guidance to reflect a stronger dollar. Investors, having done this money management gig for 30 plus years, my experience is that forecasting currency fluctuation is amongst one of the worst things that managements do. If they are now forecasting dollar strength in 2025, the dollar is likely to have already peaked, as we said back in December when others were also hysterically discussing U.S. exceptionalism and a strong U.S. dollar. Our opinion back then was the dollar would likely go lower in 2025, not higher like others had said. Here's an updated chart on the DXY under Trump 1.0 and 2.0 to date. So far, there's zero reason to think the dollar will gain strength this year, and others are now joining our opinion on a weakening dollar for the rest of 2025. A lower dollar means a few things for your money. First, go ahead and take that international trip and vacation now, and don't wait because the cost will go up. Second, Earnings estimates for a large part of the S&P 500, which was massively lagging last year in 2024, will have a tailwind for revenue and earnings in the second half of this year. Third, owning international stocks is timely. And finally, yes, American is exceptional, but there are times when international stocks do better than U.S. stocks. 2025 is likely to be one of those years. We previewed this back in December, and even going so far as discussing China is likely one of the best asset classes to be in 2025. So far, that one's been looking right as the herd has begun finding these reasons to own Chinese equities. Our favorite overlay of Chinese equities remains Alibaba, under Trump 1.0 and 2.0. I remind viewers that we've discussed the theme back in late fourth quarter 2024 when most in the media were saying Chinese stocks were, uninvestable. And that's what China has done since then. The Hang Seng Enterprise Index is up 34% since September of last year's lows and 20% in dollar terms. And China monetary policy is easing to boost domestic demand. Chinese tech stocks, as defined by the ChFC ETF, are up 18% year to date as of this writing, while U.S. large cap tech stocks are one of the only sectors lagging behind the S&P 500 year to date. It's not just China, but Europe, which I argue is a Chinese surrogate economic play as well. The German DAX hitting new 52-week highs, up 13% year to date. The French CAC at 52-week highs, up 12% year to date. It's lagging in some other European indexes due to its large weighting in Louis Vuitton. Investors, when the dollar peaks, international stocks streak. A couple more final bullish stats. Investor sentiment has recently plunged in the last 4 weeks on the back of a continued shotgun policy coming out of DC that, while I might agree with some of them, are rapidly slowing growth in consumer sentiment on the economy and on stocks. According to AAII, U.S. investor sentiment bearish at 47% compared to 43% last week and 22.5% last year. This is 50% higher than the long-term average of 31%. Take a look at the overlay from All-Star charts. Investors, finally, as I've often talked about, at least talked about by bearish traders when they're thinking the market is going to crash or go down big, it's the MOVE index. We've discussed this one many times the last 2 years. It's bond volatility. It's like the VIX of the Treasury bond market. Why does the bond volatility matter to stocks? Largely because bonds, and more specifically Treasury bonds, make up the largest collateral pool markets in the world, and Treasuries are supposed to be the safest collateral in the world as well. U.S. government IOUs. When bond volatility is high or rising, hedge funds must delever and sell whatever they want to, even if they don't want to. When bond volatility is declining or low, hedge funds can lever up their investments. They can take more risk. They can buy more of what they like. Take a look at the chart of the MOVE index. Investors, it's going down, not up like many on TV discuss. This is bullish for equities already, and should it break below 80 later in the year, expect stocks to start marching higher consistently, then even potentially parabolically in the end. As we previously mentioned, soft landings in the economy don't guarantee no volatility. This time around, the Trump administration seems to be going for the early shock and awe, which financial markets don't relish. However, behind the scenes, believe it or not, bond volatility is declining. That's just the data. Finally, investors, while seasonally, February does tend to be a lower return, higher volatility month for stocks, particularly in the first year of a presidential term, and maybe the tariff actions and Doge firings are this year's excuse. I don't know, but here's the historic data on monthly seasonality from Steve Suttmeyer's data group at Bank of America Securities. As you can see, while February has historically been down the first year of a presidential term, that down has traditionally been the best buying opportunity till late summer and preceded 5 to 6 straight months of positive stock returns. Historic data, of course, there are no guarantees, but since our team coined the term the old normal back in late 2022, yes, the stock markets have performed in quite normal ways versus historic economic cycles we are mirroring. Soft landings, however rare they are. For now, it's been a bull market. We are in a bull market, and however choppy things appear on your TV screens, we advise you to continue to run with the bulls, and that's bad news for the bears. Investors know that regardless of the path for the economy and financial markets in the next few months, the investment team at Oak Harvest will be here crewing the ship and adjusting our models where we can. We expect 2025 to be a very active year for active stock management. Until next week, investors, have a blessed weekend.